Good day, everybody. This is Retirement Income Options with Kirk Spano, November 7th, 2022. And I just wanted to point out that I did put up a new article. This is not on the public side of Seeking Alpha yet, but it is behind all my paywalls. So Macrodashes, the Armageddon Zombie Apocalypse. Macrodash is actually proprietary, and I'm using it at Seeking Alpha only. All right, so what do we know? We know Chairman Powell was very hawkish last week. We talked about that on Thursday, that we are a little bit worried about a credit crisis, that the dollar is being weaponized, and there's a lot of risk out there right now if the international scene doesn't get better. I do think there's still a possibility of the Fed making a mistake, but I think the bigger risk is on the international side. Could something get worse with Russia and Ukraine? Could more European banks collapse? What's going on with Iran and Israel and Saudi Arabia? France and the United States walking away from the nuclear deal. OPEC staying tight on oil and gas supplies. China continuing to squeeze supply chains. Oh, and by the way, Taiwan. So I think there's a lot on the international side that I'm very concerned about. And as we've talked about the last few weeks anyway, and it was brought up months and months ago, the geopolitical use of the dollar under the guise of thwarting inflation. It may not matter what the cover is, but I think the reality is that when they say they're keeping the dollar strong and interest rates higher for longer to fight inflation, I think that it's more than that. This isn't cyclical inflation where counter-cyclical policy would work. There are structural things in play here with employment that I talk about in this article. We know that employment is not overheated. We know that wages really aren't going up that much, but we know that there's a tight labor market. And that's something that the Fed can use to say, well, employment is good right now, so we can keep rates high to fight inflation. But I think it's more than that. The inflation, again, is not cyclical. It's structural and it's manipulated. And it's being manipulated by China constraining supply chains, OPEC constraining oil and gas production, and Russia's invasion of Ukraine, which not only spiked energy prices, but really is a major component of food prices because they have cut off a lot of the shipments of wheat around the world and destroyed a lot of wheat. So even though they have ships going out of the port, despite Russia backing out of the deal, it's not what it was in the past. And also Uralkali, which is a big fertilizer company, and there's another one over there, I forget its name, they're not getting their fertilizer out. So here we have all these whammies. We have China constraining supply chains. We have Russia causing inflation in energy and food. We have OPEC keeping energy tight enough so that the impact on energy from Russia is probably greater than it should be. We have to be aware that the Fed isn't just going to sit there and say, well, you know, we're going to fight inflation by raising interest rates. I think it's more than that. They are fighting some sort of a currency war with China in particular, but also OPEC and Russia to manipulate economic development over time. And it's a tit for tat thing. China, you know, you can always go back to the little kid argument. Well, he started it. But if the president of the United States and everybody else involved in the government says, hey, Jay Powell, you're independent, but here's what we think. Wouldn't bother us at all if you really tighten the screws on inflation, because the secondary impact is a high dollar to put screws to certain countries that we'd like to have the screws put to. The emerging markets are collateral damage, and so are some of our allies. So we have to be aware that when everything starts to break, we have to pivot really fast, QE, to save everybody. And this push-pull effect, I think, is dangerous. I think the idea of decoupling from China as fast as we're doing it is dangerous. I understand that everybody dies eventually, and this is all part of waiting out bad guys, trying to wait out Putin, or trying to wait out Xi, trying to wait out the Ayatollah. A lot of policy stems around delay, and just wait for these guys to die so we don't have to go to war with them. History has shown that democratic reform, or at least a quest for more freedom, is almost always in the cards somewhere where people are repressed. So I think it's important for us to really understand the big global implications, and whether the dollar is strong because higher interest rates are here to fight inflation, or whether the dollar is strong to fight back geopolitically against a group that has ganged up on the United States and the West the last couple of years, maybe it doesn't matter, but they're both there, right? Even if Jay Powell starts to beat inflation, do we know that interest rates would drop quickly from that point? He's indicated not. If he's beating inflation and the economy is slowing, why wouldn't he lower interest rates faster at some point in the future? Why isn't a pause something to even be thinking about or talking about now, according to him? It's got to be something else in play. So I am concerned that the S&P 500 could break down further than what I've been concerned about in the past. Now, I thought that the top orange line here was probably where the S&P 500 was going to hold. That's the 2020 top. With having a few days to marinate on this and to read some of the other news with regard to China and Russia and the Middle East, not so sure. I think you might see pretty big plunge down to the 2019 levels where the repo market broke the last time and they started to add QE. We might not see a pause till the S&P 500 is under 3,000. And at that point, there might be such momentum that it keeps going down. This support line here from that retest of the breakout 2016 to the bottom in 2020, but then also this broadening wedge pattern that we've talked about. I mean, there are multiple levels this market could drop down to under the worst case scenario. Still think this is my base case in here in the box. I think probably the 2019 repo levels, a little under 3,000, are probably where I land if I had to pick a spot, if I had to put a bullseye somewhere. And that means selling cash secured puts. That means that building your positions, you have to have in your back pocket just a little bit more cash in case we get another level or two down in this market. It doesn't mean don't scale in slowly. Don't freeze like a deer in the headlights. What it means, just go slow and space out your purchases in case we get one of these hot months where everything goes straight down like March of 2020. Because I think it could happen. And it's more likely to happen given the geopolitical tensions than I think we've seen in a long time. And I know that President Biden is trying to reach out to China through back channels while putting pressure on them on the front side. And from a negotiation standpoint, typically that would make sense. Publicly and front-facing, put pressure on, and then you try to back channel a solution. I'm not so sure how that's going to work with Xi basically putting a lot of hardliners and yes men in the circle around him. He got rid of everybody who could be thought of as a moderate. Now, that might be Xi doing the same thing that we're doing. Apply pressure and then see what you can do out of the public eye. We don't know these. Nobody calls us. All we can try to do is look to history as a guide, look at the men involved, and in some cases women, but mainly men right now with Angela Merkel gone. One of the things you can look at is what's going on with China and Germany. They're negotiating deals. What will that look like? I don't know, but I'll tell you what, if you're the rest of Europe and Germany might backdoor you on China, you're going to have a talking to the Germans, because I think that would be pretty dramatically negative for the rest of Europe if Germany cuts unilateral deals with China. So this is the Retirement Income Options Show. The article's not done yet because I decided to reformat it and go back to something I had gone back to in the past. What I'm going to do is just show the technical screener every week. These are the companies that are oversold that we could take a look at selling cash secured puts on. And we can flip this around for covered calls, and certain weeks I will. There's really not a lot to sell covered calls on. There are a few energy and pharma stocks that you could look at. On the energy side, keep this in the back of your mind. On the energy side, just keep this in the back of your mind. Private equity firms have started to liquidate their oil and gas investment. But why would they do that? Well, it's because they were buying these assets out of bankruptcy. And now they've made 300%, 400%, 500% on their money. They're cashing in. They've made the easy money already. That doesn't mean that oil stocks and gas stocks can't go up another 30, 40, 50%, or maybe even double, who knows? But we're to the phase now where you ought to be very careful about your energy stocks. We're in Occidental Petroleum because we know it's getting bought out by Berkshire Hathaway. Big margin of safety. We're in Permian Resources because their assets are dirt cheap and it's set up like a private equity fund. And they hadn't appreciated yet because they went through a merger. Since I brought this company to you at around $8 a share, now it's over $10 a share, 6 weeks later? And I would think that it'll go to between 16 and 20 by summer, maybe. It's going to move pretty quick. So when people were telling me, hey, it might still go down, hey, how much can it go down? When it was around 8, I said, just buy it. Just buy it and sell cash secured puts. So those sorts of companies are what you're looking for those special qualities, those things that the market doesn't value. And there's a lot of that out there. One of the companies that I've been looking at all morning is Kohl's. There's a couple of articles on Seeking Alpha that I think one even got an editor's choice. And I'm like, they're not talking about the most important things with Kohl's. The most important part of Kohl's is the real estate. That is why private equity firms tried to buy it. They tried to get a vulture price on Kohl's because they have a great real estate footprint. At some point, I think there's going to be a private equity firm that just says, hey, we'll buy some preferred shares and some common shares, and you can have the money to redevelop a bunch of real estate. It won't be great initially, but down the road, the private equity firms don't do anything where they can't triple their money or better. That's where my criteria comes from. If I can't triple my money or better, I don't bother. And granted, I have a 5 to 10 year outlook, which isn't always consistent with people's emotions, but I still think it's the right way to invest. Kohl's here is double bottoming. Now, does it get back to the 2020 low? I'm not sure. But this is a company that for certain investors, those with some stomach, really should be thinking about. Get to know the company. Go to a Kohl's store near you. Take a look at the footprint of the real estate. Is there a gigantic parking lot that's mostly empty? Maybe with a strip mall on one end? Could they build other things in that footprint if they have the cash? The only thing I don't like about Kohl's strategy right now is they're opening up those micro stores, and I just think that's a shit idea. So I am going to write an article about Kohl's, and I'm going to advocate for the CEO to be fired because she's not doing a good job. But with good management, Kohl's could unleash a lot of value. With bad management, they could just get taken to the cleaners by smarter people on a takeover bid. So we'll see. I mean, I guess a takeover probably still makes people money from these prices, but Kohl's should probably be $100 to $150 stock from what I can tell, if they handle things correctly. Right now, their stores aren't selling the right stuff. The CEO chased a trend that petered out. It's just completely behind the curve. Switched over to casual after the casual boom. Now the people are going back to the office, and the last millennials are getting married, and the Gen Zers are starting to get married. They have a crappy men's section for sure. They're losing all that business, which is dumb because with the exception of like Men's Warehouse and whoever it is they merged with, Joseph A. Bank, there's not a lot of great places for men to go and buy clothes unless you're really going, expensive. Why Kohl's doesn't capture that middle and upper middle market for men with all those stores and all that buying power, it just blows my mind. I mean, they really could be doing a great job, but their buyers and their strategy for retail sales, it's just such shit. And I've been telling them that for years. One of my friends just became, I believe, a vice president there. I'm going to tell her. But I'm going to write this article, and I'm going to lay into the Kohl's management, because for them not to be maximizing their real estate footprint, not to be spinning out a REIT probably is what they should do, just doesn't make sense. It's backwards looking management. It's people who don't have a lot of creativity. Their website and their app are still shit. And they've got a partnership with Amazon. How can that be? So when some kid on Seeking Alpha tells me about their great long-term strategy, but doesn't describe their long-term strategy, it says two things. One, the kid doesn't know what he's talking about. And two, long-term strategy is A, kind of shit and sort of doesn't exist at the same time. But the assets. Kohl's is a company that Warren Buffett warned you about. At some point, idiots would run something and cause it problems. So the business better be all to withstand idiots. We'll see. I think the real estate wins in the end. I think we get an idiot price because idiots are running it. Then I think it gets better. So we just want to find the value price, given that I think maximizing the real estate takes it to 3 figures. We'll see. We'll see how far down the idiots drive it. 20-ish seems pretty cut and stone. So when I look at companies, now you know how I'm thinking. We take a look at this chart. RSI is the shortcut. You want to learn how to use a lot of this, but RSI is the shortcut. Interestingly, I just had a Intel lawyer in my house today. I was taking care of his dog. Still think that you should be loading up on Intel, sell the puts and own some stock, because I think Intel still going to be way over $100 at some point. Here's the format that I'm going to use. Just going to give you a couple favorites. I got to put Intel in here. I haven't finished, obviously, but I'm just bringing the charts back. I'll put in an option trade in here, and that'll just be the one, and we'll just change it week to week. Super easy to follow. Retirement income options going forward. The Stocks of the Week article will have all the verbiage. But these are the trades. These are the trades you're looking for. All year long it was about playing defense. And we're getting closer and closer to playing offense. We just don't know quite how close we are. Slowly scaling in right now. But if something bad happens internationally, which I would be surprised if it doesn't, we'll probably have another leg down or 2 or 3. Now, that mainly is going to impact the S&P 500 companies. The small caps and the mid caps are already beat to hell, and they've started to outperform. When you're down 80, 90%, not much further down you can go. And you do get to the point where you just ask the question, will they be around in 5 years? Almost all the SPACs hit that point where the question was, will they be around in 5 years? Somebody asked me about Generac. I will discuss this in the Stocks of the Week, but I think that Generac, we have to be careful of technically because I don't think it's firmed up yet. It's down about $4 today. They're getting to the point where when you project out their earnings, they're going to be, I think they're going to out-earn SolarEdge and Enphase at some point. I think they're going to win that market. And it's because they already have relationships with so many more companies. Sort of the same reason, one of the reasons I think Ford is going to beat Tesla. Ford has built-in customers. Generac does too. So when Generac goes somewhere and says, hey, we can integrate your generators and your solar and that windmill if it's a big enough place, we can integrate everything, deal with one company. I think that's going to play. Remember, Generac has a deal with third largest solar builder in America. Their technology is basically right there with Enphase and SolarEdge, a little different. They might be one generation behind, but they're going to enter that oligopoly, and they're coming in at a spot where they're going to take market share and drop money straight to the bottom line. It's basically going somewhere and saying, oh, you want one? How about 2? And they say, sure, let's have 2. No extra work, more money. If you take a look at the Inflation Reduction Act, which I talked about in the macro piece, what you realize is that everything is moving really fast right now on the cleaner energy, on the decarbonization, to the point where Europe is complaining about the tax laws. Europe did a point by point 7 things or 9 things that they think gives the United States an unfair competitive advantage with the Inflation Reduction Act, which is, mainly directed at energy and healthcare and paid for by a minor tax on corporations that weren't paying taxes. It was a budget neutral bill. And people talk about, overspending in the government, and then we get a budget neutral bill that does a lot of good things, and then that's not going to get talked about. So the clean energy and the decarbonization, all the things that I've talked to you about all year, they're really kicking into high gear. And once we have a little bit more alternative energy, just a little bit, and we get 1 or 2 years of extra oil and gas production and refineries continuing to maximize their capacity, which they are, you're going to see the United States come out of this unbelievably well, because we'll be selling energy, even more of it than we do now, and it'll still be cheap here. We only have to add 3, 4, 5% more alternative energy to crash energy prices in the United States. Think that through. We're basically at the margin right now, and if you add 5% more energy, prices come down a lot. We're within about 2 years of that happening because there's record installation. I've touched on this point a bunch of times. FERC, Federal Energy Regulation Commission, I think that's what it is. In my head, that's what it is. Says that we can get 80% of our electricity from solar and alternative energy by the end of the decade. It's already in the pipeline. Do we need that much of it to lower prices? No, because we're not really that short on energy. A few percent, that's all we need. So how free will we be to sell our remaining oil and gas capacity around the world as EVs pick up, as alternative energy comes online, as the grid gets upgraded? And all these things are moving at record paces, even with tight labor markets. Imagine if we had 10 million more people in here to work. All right, so I'm going to get this done, put in some trades for you, and then we'll just update this every single week to make it super easy to follow. All right, have a good day. Somebody asked, actually, okay, one more thing. So sell the rips is still a good strategy. It depends on how much you trade, right? I do think that I'm going to lighten up if we get a rally here in the next several weeks or into the end of the year. Because in my mind, this bear market's not over. So if we get a 7, 8, 9, 10% rally up to around 4,000 on the S&P 500, I think that's probably sellable. We'll keep an eye on it. I mean, there's always the possibility that, Biden and Xi talk and they're like buddies, but what are they at? Not very high, I don't think. I will just show you the TLT chart real quick. It's in the article. I don't think TLT should go down below the lower 80. But if we need the dollar to be stronger for geopolitical reasons, there's another big wave down in TLT. So I'm not trading it yet. I'm not even buying it yet. I need it to be in the 80s, the lower 80s, for me to be interested. Now, interestingly, this is my approach. Here's Shooter's approach. Did you notice what my price was? 83.40. He came in at 83.07 using Elliott Wave. I used kind of a very abbreviated quantitative approach and charting, just basic charting support levels, and I got about the same price. So again, Shooter and I come at things from different angles, and when we end up at the same place, you really ought to pay attention. If we end up at different places, if you're a trader, listen to him. If you're a longer term investor, probably listen to me. That would be your shortcuts. All right. Have a fantastic Monday afternoon. I will get this done probably after the market close. You can start taking a look at what applies to you for your slices in your portfolio. All right. Have a great day.